It's no secret at this point that my two favorite ETFs are SCHD and VGT. I like these ETFs for completely different reasons, but mixing them together works incredibly well. A 50-50 mix of SCHD and VGT has outperformed the market for well over a decade. And this isn't just closing our eyes and swinging for the fence type outperformance. It consistently dominates the S&P 500 in both good and bad years. This magic formula gives a growth value tilt that's similar to VOO. And you've probably read stats that well over 90% of investors fall short of the returns of the S&P 500 over any long period of time. And that's why many smart people, including the great Warren Buffett, think that 99% of us normal people should just invest in the S&P 500 and call it a day. And I think that's a solid idea, but in this video, I'll show you how I've been able to outperform the S&P 500 while on autopilot. We'll also show some examples of how beating the market by just a couple percentage points each year compounds into massive wealth over time. If you're new to the channel, welcome. My name's JFT&x, and here we aim to grow your wealth with simple, time-tested solutions. Please monster mash that like button, subscribe if you haven't already, and drop me a comment down below with anything that comes to mind. We had one new channel member this week. A huge shout out to Paul S. I really appreciate you joining the channel membership, and I appreciate all of you that have been here all along. You make this possible. You know what time it is. Let's grow. The market. Let's start with the competition. It is incredibly difficult to outperform the S&P 500 for more than a decade. The S&P 500 consists of 500 of the largest companies in the United States. These 500 companies account for about 87% of the entire US stock market. When you buy an S&P 500 ETF, such as Vanguard's VOO or VOO, you own a small slice of the 500 biggest companies in the country. And VOO has a razor-thin expense ratio of 3 basis points. This means that you will only pay $3 annually for every $10,000 you have invested in VOO. And you may be thinking, why would I buy all 500 of these companies when I can just simply handpick the best ones from the basket? And this is exactly what I thought when I was getting into investing. But it's hard to do because businesses are constantly evolving. Around 20 companies are replaced from the S&P 500 each and every year. This means that the company either went bankrupt or underperformed compared to the new up-and-comers. Holding VOO is kind of like a cheat code because it will automatically update your holdings without you lifting a finger. You don't need to worry about studying the market 24/7. And as an extra bonus, you will smash the returns of most of the experts out there. But you won't smash the returns of all the nerds out there because VGT plus SCHD equals magic. If you make me choose between my kids, VGT is my favorite. This is because I'm a past, present, and most importantly, future tech bull. VGT is up over 550% in the past decade alone. That is ridiculous. VOO is up a respectable 250% in that same period. So the question might be, why not just throw everything into VGT and call it a day? While that is tempting, we have to keep in mind that the past 10 years have been a massive bull market. What happens when we have a major tech pullback? And we got a little taste of that in 2022 when VGT had a total return of negative 30%. Meanwhile, VOO, the S&P 500, was negative 18%. And yet, the 50-50 mix outperformed the market in 2022. Wait, what? Don't sleep on the other half of the equation, SCHD. Its total return of negative 3% in 2022 outperformed the market by a wide margin. Another tidbit, SCHD has never lost more than 6% in a single year. I know we're caught up in this crazy bull market, but that stabilizing force of SCHD is more important than it appears. Remember, negative returns hurt you more than positive returns help you. A simple example, if you have $100,000 and you lose 50%, you now have $50,000. You would need a positive return of 100%, not 50%, to get back to your original $100,000. VGT and SCHD are best in class for what they do, but as an extra little bonus, they have very little overlap. Check this out. I'm out here on Fund Overlap. It's a really cool website that you can use, and you just Google Fund Overlap. It should be the first hit. But what I've done is I plugged in VGT and SCHD and hit Find Overlap. You can see the overlap by weight, and that's what you always want, is to look at weighted overlap, because you could have 12 companies that are the same, but if they're only 0.01% each, then the weighted overlap's basically zero. So this is the actual overlap percentage of holding the two ETFs, and you can see it's 3%, which is very low for these two. And just as an example, some of my other favorite dividend ETFs, like I like DGRO, 17%. So when tech crashes, and VGT is all tech, 100%, 17% of DGRO is going to get hurt as well. Don't like that. And VIG is another popular one for you Vanguard people, which I'm a Vanguard person. 25%. Again, that's the last thing you want when you have a crash. That's the power of SCHD. I'll throw in one more, VYM, a little higher yield, lower growth, and it's 12%. I don't think it's nearly as good as SCHD personally, just in a vacuum, but even it has 12%, and it's considered fairly low tech in quotes. So it's a powerful 1-2 punch. We will dive deeper into a backtest to show how the 50-50 mix dominates VOO over long periods of time. But first, let's learn more about the key metrics of SCHD and VGT. VGT Details. Let's hop over to my screen to find out what makes VGT so special. I've pulled up VGT on Seeking Alpha, which is my favorite site to research stocks and ETFs. And I do have a link in the description below if you would like to try Seeking Alpha Premium for free. And if you like what you see, you'll save money on your first full year. The thing I'd like to point out on the summary tab is that VGT has a very low expense ratio of 10 basis points. That's pretty good in the growth ETF world. So it keeps the money in your pockets. You pay $10 for every $10,000 under management per year. And then it also has a whopping $99.3 billion of assets under management. So this baby isn't going anywhere. It's popular for a reason too. And then the last thing I'll point out in the summary tab down here in the fund profile is that VGT is passively managed. And that's incredibly important because we don't want gut decisions ruining our portfolio. You can see here that it seeks to track the performance of the MSCI US Investable Market Index Information Technology. That is a mouthful. Basically, it's a technology broad index that's passively managed. You get exposure to small cap, mid cap, and large cap tech companies. Now we're out on the holdings tab, and you can see the holdings breakdown here is 100% technology, basically. We'll just round up. And this is one I want to spend a little time on, actually. A keyboard warrior was going back and forth with me in the comments last year on my video. So the general consensus was that Apple and Microsoft were weighted way too heavily. And I actually have a sticky note here. As of last year, Apple was 22.19%, Microsoft was 20.84%, and Nvidia was 4.15%. This is my video last year. And what I tried to explain to this person is that it essentially works like the S&P 500. Yes, they were really heavily weighted because they're huge companies, but if another company blows up, it will find itself in the same boat because we're talking about market caps here. And case in point, most Nvidia employees are literal millionaires at this point because the company's gone up so much in the last year and change. And guess what? VGT got to experience the juicy come up. It's now 15% of the index instead of a mere 4%. Yes, some of these numbers look big. You're 17% in Apple, now you're 15 in Nvidia and 13 in Microsoft. But as other companies come and go, or as these ones fall, yeah, of course it hurts when they fall, but it will weight itself down without massive losses because you offset it with the up and comers like Nvidia. So I'm actually glad an example like this played out. Okay, we're out on the dividends tab, and I know, VGT is a growth ETF, so we're not overly concerned about the dividends, but it is kind of nice as a little bonus to have some solid dividend metrics. And it actually has an A dividend grade on Seeking Alpha. You can see the low starting yield of 0.59%, but the trailing 12-month dividend growth rate is 19%. And when we zoom it out 3 years, it's 8.32 compounded annually. And over the last 5 years, it's 6.43. And over the last 10 years, it's an astonishing 14.6%. 11.68%. So again, not a dividend ETF, but they're growing pretty darn good. Just get a quick little look at what that looks like. You know, you can see pretty steady growth. It plateaus a little compared to SCHD, but I'll take it. All right, let's get to the real stuff. We are on a growth ETF here, so we're out on the charting tab, and I've pulled up total returns. And you can see I'm here on year to date. The year pretty much just started. It's January 22nd, 2025 as I record this. So this doesn't tell us a lot, but they're both just above 3. Let's zoom it out a year. And the S&P 500 had a fantastic year, as everyone knows. And right now on the rolling 1 year, it has a total return of 27%, which is amazing. VGT's been steady as well at 29%. And it's funny because VGT must have dropped some good weight. It actually outperformed in 2024 by about 7%. And then we zoom it out 3 years, you can see tech's had a nice little run here at 63% compared to the market's 44. Zoom her out 5 years and we're at 158 compared to 98. So it's starting to get quite the outperformance. And then let's just take this bad boy 10 years here. And we're at 588 compared to the market's 264. Just to show that it hasn't only been the last 10 years. I zoomed out 20 years, so I had to replace VOO with SPY. But you can see VGT since 1/31/2005 is up 1,574% to the market's 624%. I mean, clearly we've been on a massive bull run, but I do think technology will be a staple for many decades to come. That's great for moonshots, but what happens if we miss? SCHD Details. Let's find out what makes SCHD the perfect stabilizer for its crazy growth friend. We've pulled up SCHD out in Seeking Alpha. And again, here on the summary tab, we can see that SCHD has an extremely low expense ratio of 6 basis points. So $6 for every 10,000 managed annually. And it has a whopping $68 billion of assets under management. I would guess this will be very nice in the near future. And much like VGT, SCHD is passively managed, and you can see here that it seeks to track the performance of the Dow Jones US 100 index. And just to show more information about that index, it pulls companies that must have paid dividends for 10 consecutive years, and then they have to have a high enough market cap and high trade volume, and that's a pretty easy requirement. And then once it pulls in that universe of stocks, it ranks them equally on free cash flow, dividend yield, return on equity, and dividend growth rate. So it doesn't focus exclusively on dividend metrics. It also ensures that the companies have clean balance sheets and they're sustainable moving into the future. And then the holdings breakdown of SCHD, you can see it's fairly balanced. It has about 19% in financials, that's a little high, 16% in healthcare, 14% consumer defensive, 13% energy, 12% industrials, and 10.5% of consumer cyclical and technology as well. You can see technology is weighted way down here compared to most ETFs. And for its top 10 holdings, and I won't read them all, they're pretty big names for the most part, but you have the top 10 making up 41% of the ETF, and there's 103 companies in total. And SCHD does cap individual holdings at 4%. Now they do run up a little in between rebalances. And now we're out on the dividend tab, and this is where SCHD shines. We'll start on the scorecard here. You can see it's an A+ in dividends, and it has a nice starting yield of 3.52%. And then its growth rates are amazing. So its trailing 12-month dividend growth rate is over 12%. And then its 3-year compound annual growth rate of the dividends is around 10%. Zoom it out 5 years and you're at 11.6%. And over 10 years, it averages growing by 11% per year. Again, this is what you compare to inflation and or your salary. So I would take an 11% raise every year. I don't know about you. And then recently it hit its 13th consecutive year of dividend growth. And it's existed for just over 13 years and therefore has grown its dividend every single year. And when we look at the 10-year dividend growth chart, you can see it's just a consistent monster. You go in 2015 here, you go from 38 cents and you steadily make your way up all the way to almost $1. That's 99 cents per share. All right, we're out on the charting tab and things are not looking so good here. Now, in 1 year, SCHD did a respectable 13%, you would think, oh wow, that's pretty good. You know, that's above average over the last 100 years of the market. But the market was up 27%. So SCHD severely underperformed in the last year. In the last 3 years, we have a similar story. SCHD is up 20% to the market's 44%. When you zoom it out 5 years, it's still ugly, but it's a little closer at 69% to 98%. And stretch it out 10 years and we start to even things out a little more. We're still down, but it's 201 to 264. I know I've shown this one a few times if you watch my other videos, but I like to throw some perspective out there because there's a lot of SCHD haters over the last couple years. But when we zoom out from 10/17/2011, which is SCHD's inception, all the way through 12/31/2022, so just take out the last couple years, SCHD was actually thumping the market by a decent margin, 316 to 285. Yes, it's been a rough ride lately, but who knows what the future will hold. Theory crafting is fun, but show me the money. The 13-year backtest versus VOO. It's time for the moment of truth. Does this mix really dominate, or do I need to delete this video? And the more I think about that, if you're watching this right now, it dominated. We're out on Portfolio Visualizer, and I've put in 2 portfolios. Portfolio 1, we have the SCHD VGT mix, and portfolio 2 is VOO. And you can see right here, this is VGT 50%, SCHD 50%, and VOO for portfolio 2 here is at 100%. And for the settings here, I have from 2012 through 2024, so that's 13 years. And we're starting with $10,000 and we're contributing $1,000 per month. And then the reinvest dividends is yes, display income is yes. And we are going to hit analyze, see what happens here. And again, we have 13 years from January 2012 through December 31st, 2024. And I like to start on the performance summary. You can see that with our starting balance here and those contributions, we have an ending balance with the SCHD VGT mix of $590,000, where those same contributions would have ended with $477,000 if we went with the market. So we won by over $100,000 during this time frame. And some of this return information we'll get into down below. But if you notice, besides standard deviation, which is a little higher, everything else favors the mix. The CAGRs, the best year is better, the worst year is better. The drawdowns are very similar, and then the risk-adjusted return ratios are better. So it's a good, solid, balanced mix. And we see a little more of that on this portfolio growth chart. It's just showing the total value of the portfolio, but you can see that things go up and down together. So it's not like we're comparing 100% Bitcoin to the market. Like clearly we're making something from a growth value perspective that somewhat mirrors the market here. Okay, now we're down to the annual returns here. And you can see that the blue is the SCHD VGT mix, and the green is the market VOO. Now, one thing that I'd like to point out, in my last year video on this topic, I pulled the last decade, so I just pulled 10 years. And at the time, that was from 2014 through the end of 2023 for 1 decade. But I had a lot of people in the comments chirping that the market actually won the 2 years before. And you know what? You're right. So I'm gonna put that in. And you can see that the mix actually did win for 10 consecutive years from 2014 through 2023. It never lost a single year on both up and down years. But in the first 2 years, the market did outperform the mix, just barely on that one, and by a decent amount on that one. And then last year, in 2024, the market came back with a vengeance and beat it by a solid 4.5%. So VOO had a fantastic year last year. What we need to do here is zoom out and see what happens over time. And to do that, we can take a look at our trailing returns. So if we look at the full time horizon, the full 13 years with the wins and the losses, the mix is up 17.06% annualized, and the market, VOO, is up 14.71%. So a decent little lead there. In the last 10 years, it's just over a 3% lead, at 16.33% compared to 13.07. In the last 5 years, you have a comfortable 2.5% lead at 17.1 to 14.5. And then the 3-year is nearly tied. The mix barely ekes it out. And then as we know, the 1 year belongs to the market. It had a killer 2024. So I guess the mix doesn't win every year, but when we zoom out, it still has quite the large win overall. And for the portfolio income, I know a lot of long-term investors usually just reinvest the dividends, but if you needed portfolio income, you can see that the 50-50 mix dominates the market when it comes to dividend growth. So back in the day, they were very similar dividends per year. In fact, the market was a little ahead. But then over time, you can see with the crazy growth of VGT and SCHD on the dividends being double digits for well over a decade, you start to pull away. And all of a sudden, when you look at last year, you would have 11,500 dividends compared to the market's 5,800. It's kind of unbelievable. And this is the last one we'll emphasize here before moving on. This is some analysis on the holdings, and you can see VGT and SCHD, and it shows their category and everything. Where I want to focus is the PE ratio. So when you do the weighted mix, you have a 28.06% PE. And you can see right here, you get 71.5% large cap. You get a nice chunk of mid cap with almost 20, and then you get a solid 9% small cap. I scrolled down to the same thing for VOO, and the PE is 27.14, so just under 1 lower. You get a little better value here, but it's a very similar blend between growth and value. But then with the market, you get 81.5% large, 18% mid. And it basically took all that small and dumped it into the large. So I like the balance a little bit better of the mix above as well. Small wins create wild results over time. The difference compounds. Beating the market by 2% never feels noteworthy in the moment. But the wealth accumulation really does accelerate at a strange pace when you string together multiple wins. Let's check out a few examples. We're going to start with an example that has nothing to do with these specific holdings. We're looking at the 100-year average return of the S&P 500, and it sits at just above 10%. And again, this is not accounting for inflation, so the real return would be 7%. Nominal return has been 10%. So if you start with $0 and you put in $1,000 per month, and it grows at 10%. You can see here, and I clump these into 5-year increments just so there's not so much data on the screen. After 25 years, you're pretty easily a millionaire. And after 30 years, you're a multimillionaire. And that's pretty good. And that's really is how it works. This compound stuff, it never feels like it's adding up, but it does. Now, I noted this is the full returns in the last 13 years. Okay, first of all, this is ridiculous. I mean, we cannot expect this to continue, just to be crystal clear. But I want to show what the difference of 17.06 compared to 14.71 looks like. Before I do that, I'm going to copy paste these numbers from the 10% right here, and that way we can see the difference. So we're going to plug in, instead of 10%, 14.71. This is what VOO has done in the last 13 years. It's mind-boggling, right? Instead of 2.2 million after 30 years, you have 6.5, and 3 instead of 1.3. It's just incredible if you look tier by tier. And it's funny because you'll notice the power of compound. That 4.71% difference after 5 years, 87.8K is a lot more than 77, but it's something where you'd look and be like, it's close. Same with even 270 to 204. But as you notice, the more time that happens, the eighth wonder of the world just does its thing, and all of a sudden you're triple at the bottom. And we're gonna copy paste these ones right here before we go. Let me expand that. Can you see it? I hope you can see it. I think you can. And now we're going to put in the ridiculous, and never use this for projections, 17.06%. That gets you up to 11.2 million instead of 6.4 after 30 years. Now that's a long time, but 15 years, this is 13. 15 years, it starts to see quite the difference. You're at 822 instead of the VOO's 649 or the historical averages 414. So that's how compound works. And I can tell you from personal experience, this mix has really worked like this in reality. The mix of VGT and SCHD has been outstanding for over a decade. If you've been around this community, you know that I personally built my wealth on this train. This isn't one of those hindsight's 2020 type things. In full disclosure, I hold VOO as well because it has a long track record and we never know what the future holds. Look what happened in 2024. all those really smart people can't be too far off base. Thanks for watching this one all the way to the end. And check out one of these 2 videos if you want to continue down your path towards financial freedom. Remember, money is overrated. Freedom is not. Thanks for watching, and I will see you here in the next one. Purr.